One of the absolute best opportunities for making consistent profits lies in any event that has the potential to create volatility in the markets, which just means that the price of currencies could possibly move a lot because of it. These events are called risk events. A risk event can be anything, but the ones that happen like clockwork, week in, week out, are the economic releases and events that you see on the calendar every day. As we mentioned earlier, the golden rule of analysis in trading is thinking about how the market will react to something rather than what actually should happen based on logic. Very often the price will move in a way that is confusing to the rational brain, but when you start getting to know the market and understand how it thinks, just like you would any other single person, you can then start to predict its behaviour in certain situations. And risk events are the perfect opportunity to practice this style of thinking. So how does it all work? And what should you be looking out for? Well, the first step with risk events is to be aware that risk events are coming up. This is easy because we provide you with an economic calendar each morning with them all listed. All professional traders will be aware of what risk events are coming up within a 1 week time frame, and it's highly recommended that you start training your brain to be aware of what risk events are due to occur over the coming 7 days. The next step is to be aware of which currency will be affected by each event. Generally, it's fairly simple. Any US indicators will affect the dollar, any UK events will impact the pound, and so on. So let's use an example to illustrate the point further. Imagine we know that there's a fairly important risk event from the US coming out next Wednesday. We therefore know it will likely move the US dollar. Our next step is to figure out what the general market feeling is around the US dollar at the current time. Is everything thinking, or is everyone thinking that the US dollar is solid and it will get stronger, or is there a concern in the air about whether or not the central bank of the US might cut rates at its next meeting, or even that the economic data over the past few weeks has been showing signs of weakness? The word traders use to describe this feeling of the market is called sentiment. So when you hear that sentiment is negative, it just means that the market is feeling pretty depressed about things and is more inclined to sell whatever currency it is they're depressed over. If the sentiment is positive, then the opposite will generally be true. Either way, you need to conduct your research and analysis and find out the general feeling or sentiment of the market at the time. Finally, you need to see what the expectations are for the risk event in question. The calendar will give you these expectations at the end of each Friday for the week ahead. Firms like Bloomberg and Reuters poll economists from around the world and get their opinions and average it out to a general expectation for each risk event the following week. We provide these polls and calendars for you to also use on the event calendar page just below the main daily calendar. By looking at this information, we know how the same figure came out last time and also how the experts think it will come out next time. If it is expected to beat the previous release, then it gives a positive expectation. And if it's expected to be worse, this gives a negative expectation. Now we simply need to compare the expectation for the event with the general market sentiment for the currency. If the general sentiment is positive and good, and we expect the next big risk event to show more of the same positive information, then there is almost no reason for the market to sell that currency going into that event. In the week leading up to it, there's a strong chance that the currency will remain supported and even increase in price steadily. Vice versa for negative expectations. If it matches a negative sentiment, the chances are the currency will get sold into such an event. This is a great tactic to look out for, but of course sometimes there just may not be enough sentiment around to really get a good feeling at all. Sentiment is gathered simply from the news feeds, research and articles that you will be studying each day. As a very general rule, if an opportunity doesn't really stand out to you, then there is probably no profitable trade there. So it's best to move on and look for risk events that do match up with more clear sentiment. This tactic is called trading into risk events because we are combining the current sentiment with the expectations for the release to give a nice trading opportunity over the next few days. When the risk event is released, there's a whole different type of opportunity on the table. And that is the opportunity to trade out of the risk event instead. Trading out of the risk events is a similar process. For example, if you still need to do all the same research, you still need to understand what the current sentiment is and you need to understand what the expectations are. But this time, you are waiting to actually see what happens with the event. At this point, three things can happen. Firstly, the event comes out as expected, in which case not very much will happen at all. In fact, there's a common phenomenon called buy the rumour, sell the fact. And this is when the markets trade into a risk event, moving price as it does, so that when the event actually does happen and it all comes out as expected, there is no one left to get in, and so the ones who are already in start exiting their positions to take profits, which causes the price to go the opposite way, which should go according to logic. Remember, we talked about not using logic to predict price action, and when you fully realise how the market thinks, you will also completely understand why this is one of the biggest things firms teach their junior traders. The second thing that can happen with a risk event release is that it comes out worse than expected. Now, many retail traders will dabble in trading news and conducting fundamental analysis, once again use their logical brains, think that the market should sell the currency into this scenario. But again, what happens next all depends on how the market is feeling and what it thinks will happen next based on its irrational emotion decision-making process. Generally, the market will think what will happen next. So if the data is worse, but the market feels it doesn't really change the big picture, they might completely ignore it. On the other hand, if they think it changes everything, then the sell-off will come and it will be likely the over the top and slightly extreme. This is where your understanding of what the current sentiment will be will help you make money. You'll be able to make this call quickly before the move plays out and the opportunity is lost. The trick to being a profitable trader is being able to read and predict how the market will react based on what is happening, and the best way to get to know the market is to simply engage with it every day, trade it, watch it and listen to it through reading news and analysis. The third thing that can happen at a risk event is that it is better than expected. And again, the reaction is not one of mere common sense, but all about how the market thinks it will alter what will happen in the next scenario. So in summary, trading risk events is a very powerful and predictable way to make money consistently, but you really do need to focus on Mr. Market and how it's feeling and how most likely to react given all the circumstances. The advantage of getting good at trading risk events is that they are set times and they are perfect for anyone with full-time jobs or schedules that don't allow them to be sat around at screens all day. You can have a look at all the upcoming events for the next week, identify the ones you think the market will pay attention to, and then see what the expectations are and trade either into them or out of them based on how the current sentiment compares with the expectations and your personal preference.